Hi, this is David of Bionic. Continuing the series of CFA videos for the CFA Level 1. This is an introduction to technical analysis, and like many others, we start by comparing or contrasting it to fundamental analysis, which may be more familiar to you. And fundamental analysis has the advantage in that it is clearly an inquiry into a wider number of fields or disciplines and uses a broader data set, including financial data, economic data, and is influenced by societal and political issues, among others. So it's a wider data set. However, that data is invariably dependent on estimates and assumptions. If we think about even the cash flow inputs like cash flow from operations or free cash flow, those depend on management assumptions or estimates and accounting decisions. So it's less than totally objective. And finally, we consider fundamental analysis to be theoretical in the sense that we're trying to see or find out or discern the long-term or intrinsic value of the share. Compare this to technical analysis, which clearly depends on a narrower inquiry into a more limited data set, probably just price and volume data. However, the advantage is that it's operating in liquid markets where that data is going to be pretty much objective. So here, look at an advantage of technical over fundamental analysis. It uses objective data where fundamental analysis is always having the doubt of certain estimates and assumptions. And then finally, technical analysis is considered practical as opposed to theoretical. Keep in mind, these are compatible. We can use fundamental analysis to determine the intrinsic value of a security, and then technical analysis to time the purchase or sale of that security. So if we think about the basic charts, that's part of this introduction here, we might first ask, what are the beliefs or tenets of technical analysis? Well, there might be three. First, supply and demand determine prices. Sometimes the statement is stronger in the sense that it says it's only or solely supply and demand that determine prices. Second, if that's true, then shifts in supply and demand either cause or are the only or sole cause of changes in prices. And finally, here's the big implication. Prices can be projected because prices tend to move in trends and patterns tend to repeat. Notice it's not an absolute statement. These are tendencies. So probably the most basic chart is a line chart, and that's here for the S&P 500 Large Cap Index for the year 2011. The advantage of this basic line chart is that it's very intuitive or obvious. We can see the price action over the year, and we have some sense of volatility as well. The glaring disadvantage of this is we only get one bit of data per time interval. In this case, this is a typical daily price change chart. So for each day, we're getting one bit, and what we're getting is the price close, or the price at the end of the day, or the daily price close. So not much information compared to the bar chart, which gives us fully 4 bits of data for each day. Same S&P 500 Large Cap Index here. Chart's a little bit more complicated, but we're getting actually a lot more information from the perspective of technical analysis. If we zoom in here, what we're getting is a vertical line from the highest price or daily high to the daily low. So notice this line is going to be long or short, which is not exactly volatility, but it's a proxy for volatility. And then we get crosshatches. Here on the left is the daily price open, and then the closing price. This chart that we've got here actually helps us with additionally with some color, which is to say that when the close is lower than the open, so we're trending down, it's in red, and then when we're trending up, it's in black, and that indicates that the close is higher than the open. But you can see here we've got some long lines here, which would be a proxy for some high intraday volatility. And then on the left, we're going to have an open, and on the right crosshatch, we're going to have a close. The candlestick chart also gives us 4 bits of data per time interval, or per day in this case. So again, we've got the same S&P 500 index, although it's arguably even easier to discern those bits of data. And so if we zoom in here, we can see we have the same vertical line from price low to price high. However, if the stock opens and then closes the day higher, we have a white body of the candle. So this is the body of the candle. and then the vertical line is the wick or shadow of the candle. On the other hand, if the stock opens here but closes at the end of the day lower, then that body is going to be colored red or black as opposed to white. So that coloring immediately tells us if the day saw a drop or an increase in the price. So for example, if we take the 19th here, what we've got really is a short candle when we think about the shadow combined with the body, but it's red, so that means we know that there was low volatility owing to the short candle and a drop as the stock opened here and closed here. Go compare that to the 20th, where we can instantly see that we had a higher volatility day and also an increase in the price of the stock as it opened here and closed here. Scale in these charts is a consideration, and we have the linear scale. This is the y-axis. Of course, the x-axis is the time dimension. In the linear scale, the vertical distance between $10 and $20 is going to be the same as the vertical distance between $90 and $100. In the logarithmic scale, it's the percentages that are the same. So the vertical distance between 10 and 20 is 100%, and that's going to match the vertical distance between 50 and 100. As 10 doubles to 20, that distance is the same as 50 doubling to 100. So the linear scale is generally more appropriate when there's a narrow price history, and would be typical if we were plotting the price of an individual company stock or security. A logarithmic scale is probably more important if there's a large range of values, even order of magnitude, and might be appropriate, for example, if we're plotting something like the Dow Jones Industrial Average over a long multi-decade time frame. Volume is considered a key indicator and will typically be plotted in a bar chart beneath the line chart, in this case, or a candlestick chart. And one of the first perspectives is that we've introduced a second indicator along with the first indicator, and we can look for positive confirmation. So that is to say, here, for example, the price is increasing, or we're in an upward trend on the price. If the volume is also increasing, and it sort of is right here, then we say that's positive confirmation, that the volume is giving positive confirmation to the upward trend in the price. As opposed to, notice over here, the price is increasing, but the volume is not increasing along with it. So the volume is not really giving a positive confirmation to the price trend. And finally, with respect to the x-axis, we can have a time interval really of any period we desire, daily, weekly, monthly, or annually. And so in the next video, we'll continue with technical analysis. This is David of Bionic Turtle. Thanks for your time.